Okay, now this is the big one. Escrow analysis. Okay, we're going to talk about escrow analysis. Again, I've probably viewed about maybe tens of thousands of different escrow analysis working for a loan servicer in a call center environment. Again, I've seen and went over and explained tens of thousands of escrow analysis. So let's jump into it. Now, your escrow analysis is typically tricky. So what an escrow is some people, when they make their monthly payment, a portion of those funds are set aside and collected for their taxes and their insurance. So when it's time for the taxes to be paid for the property, the servicer will make a disbursement for the taxes. And when it's time for the insurance premiums to be paid out to the insurance company, the servicer or bank will send out those funds to make sure the property can be insured and the homeowner can have that assurance. Okay? So now, by law, the servicer would typically collect 1/12 of the yearly amounts. Again, monthly basis, they would collect 1/12 of the yearly amount. So what that means is if your insurance premiums for the year is $1,200, each month they'll collect $100 to represent that 1/12 of the yearly amounts. Again, okay, so if it's $1,200 each month, what will be set aside to be applied for the insurance disbursements will be $100 collected for your insurance premium amount, right? Now, the same for your taxes. Let's say your taxes is $2,400 a month. 1/12 of $2,400 each month is $200. Then each month we'll collect $200. So that'll be 2 times 12 will equal $2,400 for those yearly tax amounts that need to be dispersed. Now, when it comes to your escrow analysis, again, that is typically reviewed annually. So once a year, right? Now, that's viewed once a year in terms of your escrow analysis. So let's say if your servicer would review the escrow analysis every March, right? They'll review your escrow analysis every March. And then if there are any necessary changes at their time, they'll adjust the payment. Now, they typically got to give you at least 30 days notice before any potential changes in the payment, whether it goes up or down. So let's say if the escrow analysis is completed March 1st, it typically take about 3 to 6 business days for it to generate. So the letter will go out around, let's say, the 7th or 8th of March, right? Then by the time you receive it, you'll receive it sometime before March is out. So they give you that 30-day notice, because if you receive it at the end of March, then the payment won't change for April 1st. Them giving you that 30-day notice, the payment will change for May 1st. Again, it was completed on March 1st. By the time you get the notice at the end of March, the payment will start and change for May 1st, whether it goes up or down from your escrow analysis, right? So again, if we do the analysis every March, and let's say we determine that, okay, we were collecting, let's say we do the escrow analysis every March, right? And then again, for your insurance, we might have been collecting $100 on a monthly basis, right? Now, let's say your insurance don't expire till, let's say, July, right? So the previous premium amounts we were collecting from March 1st, we did the analysis. From there, we was collecting $100 a month for your insurance, right? Now, your policy don't expire until July. The reason why I reference that is because when it comes to, if there are any new higher payment amounts that will need to be dispersed for the insurance premiums in July, we will still disperse that higher amount in July, right? So keep in mind, we did the analysis in March. We were collecting $100 a month for the insurance premium amounts. We thought they were $1,200, but come July, your insurance company said, hey, it was $1,200, but now we need $2,400 or $2,000. Again, I'm just saying $2,400 because I'm trying to give you like even number, like exact math, easy math. So let's say they go from $1,200 to $2,400, and again, that's just being nice. I've seen it when it doubles, sometimes triple insurance premium amounts. certain states, a lot of companies are closing. So if you're viewing this, you know that it is possible sometimes your insurance to double or go a little higher than that. So let's just say if it does double and go from $1,200 a year to $2,400 a year. Now, we did the analysis in March, but it come July, we sent out the higher amounts, right? Now, after we send out the higher amount in July, we're not going to double back and do a new escrow analysis, right? Because your analysis is performed once a year annually every March, right? So we did the analysis in March. The reason why I'm explaining this is because a lot of homeowners have a shortage. I'm going to explain to you why sometimes it can be short on a yearly basis, right? So we did the analysis every March. Come July, a few months later, they said, no, we need a higher amount. Now, we'll still send out the higher amount because that's what's due, right? And then when we send out the higher amount, now what that means is moving forward, we're already collecting the wrong amounts. So we're not going to double back and do a new escrow analysis until next March. So from July to about up to the following year, the next March, when we do the analysis, we've already been collecting the wrong amount. We've been collecting $100 a month, but we really should have been collecting $200 a month. So there's a shortage, right? So that can impact the monthly payment the next escrow analysis, right? Because we've been collecting $100 a month, but we really should have been collecting $200 a month. So it's already off the rip. Now you're probably wondering, why does the servicer do an escrow analysis, right? Well, a lot of times we do it annually because it's possible the same thing may happen with the taxes. We might do the analysis in March, but let's say if your taxes ain't due every year until November, so from March we were collecting one amount. Well, starting when the payment changed in May, so we was collecting one amount, and then come November, we noticed we needed a higher amount. So we're going to send out the higher amount regardless of what it changes to. Now, you're probably wondering, like, why we don't do the new analysis, because, again, that might happen with both taxes and insurance, right? So, but now it is your right as a homeowner to request a new escrow analysis, right? You can request a new escrow analysis. That's your right as a homeowner. You don't have to wait to the yearly annual review. At any point, any month, you can request a new analysis to be performed. Now, in the event there is typically a shortage, sometimes the servicer will automatically trigger a new analysis to be generated to recalculate the payment if we receive like a large refund from like either the homeowner or like the city or county.
In half a mile, keep right at the fork to stay on I-75 South.
Excuse me. I'm driving. But right, so the escrow analysis, you can be short. And now, if you're in the event you are short, that short is typically will be spread out over, let's say, typically be like a 12 to like 48 month period.
Keep right at the fork to stay on I-75 South.
Right? They usually can be spread out over a 12 to 48 month period in the event there is a shortage. But a lot of homeowners haven't been paying or a lot of servicers, they've been getting short. Imagine if they spread out everybody's shortage, right? So if they spread out everybody's shortage, your escrow is always in a negative due to the shortage from year to year, and you just have it spread out so far that you might have a shortage that'd be spread out for 4 years, but guess what? It might be the new analysis the following year might change that if you're being short from year to year. So anyways, a lot of servicers, they start letting you spread out or have the shortage spread out that far, up to 3 or 4 years. Now they've been saying, you know what? That $6,000 you were short that we would have collected over the 4 or 5 year period, now we need that $6,000 over 12 months. So what that means is, right, not only, so if your escrow is short over, let's say $6,000 and they want to collect it over a 12-month period, that's $500 a month. 500 times 12 is $6,000. So if you have to pay a per payment amount towards an escrow shortage, again, it was shortage maybe $6,000. If they spread it out over a 12-month period, that would be $500 a month, each month that you'll be paying towards an escrow shortage, right? So your payment could increase by $500. So again, even if your interest rate is fixed, that does not matter. Your monthly payment can change from year to year depending on what happens with this yearly review or escrow analysis, right? So just to give you an example of what can happen with a shortage, again, these are just examples, but let's say if you're paying $500 a month towards an escrow shortage, your monthly payment still can increase your payment still can increase a little bit besides the shortage, because again, we were collecting that $1,200 a month, so we needed the $100 a month for the insurance, but now the higher amount is $2,400. So when the payment changed starting May 1st, again, we did the analysis March 1st. By the time you got it, the end of March, payment was going to change for May 1st. We have to give you the 30 days in advance notice when the payment changed, right? So when the payment changed May 1st, again, now that analysis now, so starting May 1st, since the insurance increased to $2,400, again, by law, we have to collect 1/12 of that yearly amount. So now starting May 1st, we're going to need $200 a month for the insurance, right? 200 times 12. That's $2,400 for the new premium amount. So now we need $200 starting May 1st. So your payment on a monthly basis will need $200 more for the insurance, plus that $500 a month per payment amount for the escrow shortage. Again, okay? So again, the payment could change on a monthly basis because what's needed for the insurance increase, and then you also can be paying a per payment amount for the escrow shortage. So if what is needed on a monthly basis a month now for the insurance is $200 a month, and then you still have that $6,000 escrow shortage divided by 12, that will be $500 a month. So when you add that 200 plus the 500, that is how your monthly payment can increase by $700. Okay? Your monthly payment can change by $700. Again, $500 towards a month per the escrow shortage per payment amount, and then $200 because now we need more for the insurance increase. So that's $700. That's an example if your interest rate is actually fixed, right? That's an example if your interest rate is actually fixed. Sometimes your rate change may also change close in time or simultaneously while those analyses are being completed. That's a whole nother animal, to say the least, where your payment can change from the rate change, and then your payment can change from the escrow analysis changes, right? But going back to the analysis for the shortage, right? Let's say the shortage is $6,000 and it'll be collected over a 12-month period at $500 per payment. You can either pay the shortage in full if you like, you can elect to, or if you do nothing, again, that shortage will be collected over the 12-month period at $500 per payment. But if you pay the shortage in full, what that means is you pay the $6,000 in full. When the payment updates, it'll remove that $500 per payment amount that would have been collected for the shortage. Even if you don't have the full $6,000, you can apply half or whatever portion of funds you may have to apply towards the escrow shortage. And the payment can be recalculated based on that amount that you have. The servicer can play with the numbers for you. So let's say if you didn't have $6,000, you had $3,000 or maybe $2,000. The servicer can play with the shortage, recalculate the payment based on that amount, and then that shortage amount will go down, and then your per payment amount needed for the shortage will also decrease because, again, you apply funds back as additional escrow towards that escrow shortage, right? And again, you'll make that payment to be additional escrow payment. You won't make that a regular payment. That'll be additional escrow payment that'll be applied directly towards your escrow balance to take care of some of that shortage. Now, what's been happening again is some services, they're no longer taking that shortage. Before, you can be like, that's $6,000, let me spread it out over 4 or 5 years, and then it brought the payment down, because what needed on a monthly basis for the per payment amount would have been less because we spread it out over more time. But since it's only being allowed for 12 months on most accounts, some I've seen 24, you're lucky now if it's 24, but now these servicers and banks, they want their money, honestly. There's a lot of shortage, to say the least, nicely, that's respectfully. They want their money. A lot of homeowners are not really paying the shortage amounts, and then they're just pushing it back over year over year. Now, a lot of homeowners, this will create a hardship. And if it does, you will have to request for mortgage assistance. Now, to date, again, this is not the dated, but this is April 1st, 2023. A lot of this knowledge from year to year still will be applied. Now, this is April 1st, 2023. So, in terms of if it would create a hardship and you want to request for mortgage assistance, as of yet to date, there's no information as to how that will be packaged in a modification for the escrow shortage, right? Because whenever there's a shortage, that is advancements that is typically made by the servicer, right? So escrow shortages or any type of advancements that would be made or needed for higher tax amounts or higher insurance amounts, that is typically made by the servicer. Now, the servicer and your lender, or your servicer and the investor on the account, they are two different companies, right? Not the name drop, but you may have a Bank of America or a Chase. They may be the lender or the investor, but they may hire another company to handle the servicing rights of the property. So any type of advancements that are made for taxes, any insurance, or any type of escrow, that is by the servicer. That has anything to do with the lender. So if it's going to be interesting to see how they package the escrow, if they even get you approved for a modification, because a modification typically would modify the principal and interest portion of the payment to try to provide you with a more affordable payment. The escrow typically, for most modifications, those are advancements made by the servicer. They're typically not packaged into it. But sometimes they may, but it's going to be interesting to see how that happens with homeowners, because they still may, even if you're modified, they may, potentially extend the maturity date or provide that more affordable payment and create a balloon payment in the near future, again, to bring you back to a current status and provide that more affordable payment. But in terms of the escrow, that still may stand whatever those higher amounts is, because there still will be that shortage. Those are advancements that were made. They can't put an advancement. If a servicer make an advancement for your escrow, taxes, and insurance, they can't put that to the end of your loan as a deferred principal, because anything that's for the current principal, now the current principal and the deferred principal, those two together make up your total principal. So when you pay off your account, that total principal balance, whatever that is, that goes to the lender or the investor. That doesn't go to the servicer, right? It's two different companies. So a lot of times, will you be able to get approved for a modification that does anything to the escrow? It's going to be interesting how that will apply to an account. I will be sure to update you as information is available, but things change all the time. But I don't really see that in the near future being applied towards a modification, because again, advancements are made by the servicer. Whenever you're making monthly payments or you're modified for the principal and interest and whatever that total principal, whether it's a current principal and the deferred principal, because again, that's what breaks down a total principal balance. If you have a current principal balance and then anything put to the end of the loan as a deferred principal, those two together will equal the total. So I don't think they're going to be a part of them. I don't think anything with the escrow is going to be part of modifications in the near future. So even requesting for assistance may not honestly do you any good when it comes to any escrow shortages. So, but again, it's going to be interesting to see how these things play out, because even certain states like Florida, where I reside, a lot of insurance companies are really closing, and it's leaving homeowners with less options to choose from. And a lot of rates are going up. Everything in the country are going up. I live in the U.S. Everything is going up, from groceries to gas, things. Like, when it's up, it's up. They typically don't go down. So a lot of these insurance companies, they are charging, they're upping their prices for the coverage. There's a lot of storms, and they just even rebounded from COVID. So they're taking some losses too. So everybody's kind of needing their funds. It's a Peter Pay Paul type of world, but people are wanting, their money from Peter so they can go pay their Pauls too. Okay, so just to give you some examples of escrow shortage, I know I said a lot, kind of bounced around, but yeah, your escrow shortage may be short year to year. Because, I mean, honestly, that's an example. We'll review the analysis in March 1st, but come June, we may even send out a higher amount. Now we're already collecting the wrong amount on a year-to-year basis. That could happen the same thing with taxes. So if you never take care of a shortage, and even if you take care of the shortage and it removes that per payment amount that would have been collected for the shortage, you still can find yourself with an escrow shortage the following year, because again, we're going to renew the analysis in March. Those higher amounts still made at some point in the year future go out in June, and for the insurance, and your taxes may go out in November. And can you change when the taxes are due? I don't know. You got to contact your city and county in regards to that. I'm not sure. I just know when they're dispersed and how disbursements are made, and that sort of thing. And then when they're due, that all depends on your city and county. Some taxes, you might have mud tax, and you might have a wind tax or an earthquake tax, depending on if you live in the West Coast in certain states. Some taxes might be a city tax or a county tax. If you live in New York and those other states, you might have a borough tax. Additional lien taxes. So there's all type of different taxes that homeowners pay. There's like a school tax. I've seen all type of different taxes that homeowners pay. Again, just depend on where you live or when they'll be due. But contact your city and county for any information on your taxes to see if you're able for any exemptions for reaching a certain age, or you can just reach out to them to see what you may be eligible for, or if possible, for any credits. And then if you do ever receive any credits, send that into the servicer, because they'll be able to redo the payment and recalculate your escrow analysis based on any potential credits you may receive or exemptions. Same thing with the insurance. What you can do with the insurance, it is your right as a homeowner to choose to decide who will insure your property. So that's another thing. If you switch insurance, now that may provide you with a more affordable payment, because again, less will be needed. But here's the thing: if the servicer sends out whatever the servicer send out for that year for the insurance, again, we send it out. When we send out the funds are sent out for the entire year. Policies typically go from year to year, typically for 1 year. So if funds are sent out for the entire year, let's say we send out funds from the period from June, from 1 year to June of the next year, right? We send the funds out for the policies to start in June. If you cancel in, let's say, July or August, the insurance company would typically refund you the funds for the term of the policy that was not being utilized. So if you only use it for 2 months out of the 12 months, how they do their calculations, they'll send you for whatever part of that policy that wasn't utilized for the funds, they'll send you back the refund, right? Now, when you get that refund, I would advise cashing the funds and then placing those funds back into your escrow balance, right? Because when you cancel from one insurance company, you then simultaneously have to also be sending in new insurance policy documents to the servicer so they can have that on file for the new company. Now, when they get the new policy for the new company, the servicer will make another disbursement, because the insurance company will send the invoice along with the new policy documents, a proof of insurance. So a new bill will need to be paid. So a new disbursement will be sent out on your behalf, whether you ask for it or not, whether you have funds in your escrow balance or not, whether you're in a positive or not, whether you're in a negative or not, a disbursement will still be made on your behalf, because we still want to make sure you have proof of insurance. So if the insurance company sends in a new policy, we'll make the disbursement for you. And then again, when we make the new disbursement, now we'll have that new lesser amount on file. So again, not only will we have that new information on file, simultaneously, when you get the refund from the cancel policy, call in, apply those funds back into your escrow balance. Because not only will we be able to recalculate the payment based on you having or us needing a lesser amount for your insurance because it changed and went down, we'll also be able to recalculate the payment because you also placed those funds back into your escrow balance. So we'll be able to calculate it based on those two things. Again, the lesser amount needed, and then those funds being placed back into your escrow balance from the canceled policy. So we can redo the analysis. And again, as a homeowner, you have that right to request a new escrow analysis. And I know this is a lot, but this is the type of calls I've been having. I usually take about 75 calls a day. Now, since these new changes have been taking place this year in 2023, everything been going on with the world, I've been having, out of my 75 calls a day, I've been unable to take 75 because I've been spending a lot more time with escrow analysis with homeowners. So I've been dropped down maybe to about 50 or 55 calls, but about half of them have been due to escrow analysis. So half of my calls now, 50 calls, 25 is escrow analysis. Homeowners are wanting to know why their payments are changing and jumping from one amount. Now they're increased by $300 to $500 a month. So they've increasing by $300 to $500 a month due to the escrow shortage not being allowed to be spread longer than 12 months. So it's creating hardships for a lot of homeowners that are receiving monthly benefits. You know, they may be receiving only retirement or Social Security. And then, you know, those benefits are only increasing by very minimal marginal, very minimal amounts on a yearly basis. So if let's say your payments only go up $100 a year increase, let's just say $100, but if your payment only increased $400 or $500 because of these new changes, that would create a hardship. Now you're $400 on a monthly basis. Now you're lacking $400 a month because your payment, your Social Security gave or your retirement gave you $100 more. Your payment changed by $400 or $500 more. See the difference? That difference of that? Now that's on a monthly basis. So you can times that by 12. So it will create a lot of hardships for a lot of homeowners that are retired due to these new changes. So it's important to understand your escrow analysis, even for homeowners that are starting out, or you're in the middle of your 30-year term or your 15-year term paying monthly payments. It's good to understand your escrow analysis because this will be a yearly review. You will get these reviews every year. They'll send the documentation out to you in writing. So you wanna just be very mindful of when this review will take place yearly, because it's gonna increase your budget for the following year. Your payment could change, increase or decrease on a yearly basis, but it more than likely probably will increase. Not to scare you, but this is reality. Again, I worked in the mortgage industry at the collections department as a relationship manager, so I deal with a lot of accounts. I talk to a lot of homeowners. I go over these analyses in very great length. Calls me about 30 minutes a call explaining it. So homeowners want to know why their payments increase from $100 to $500 on a monthly basis. That's a large increase, even if you are financially stable. I had one account where they were short, and then again, not to go over shortage to bounce around. I know I'm talking very fast. I'm just used to talking over these calls like this in the call center. So, excuse me. If you need to replay this video, please do so. This information is very valuable. But again, it's an escrow analysis. Now, again, in terms of if you ever receive any deferrals, let's say if you ever had any hardship, you called in to request a deferral where they put a payment or payments to the end of your loan that'll be due on the maturity date. That's a deferral, where they'll typically take the principal and interest portion of a payment or a few payments and put it to the end of the loan where it'll be due on the maturity date. If you ever received a deferral for a payment or a few payments, again, that just typically covers the principal and interest portion of your payment. That doesn't have anything to do with the funds that would have been set aside for your taxes and your insurance. So let's say if you had a deferral for 1 month, then whatever would have been set aside for that 1 month for your tax and the insurance, if you don't pay that additional amount to cover that month that would have been lacking for the deferral, that also would create a shortage, along with any changes or increases. So imagine having a deferral for 3 or 4 months. During COVID, a lot of homeowners had deferrals for 3, 4 months, some 5 and 6. If you didn't make any additional payments towards your escrow during that period of time, or let's say you made partial payments and some of the payments were, either deferred, or you just didn't make those portion of those monthly payments for the escrow because you only wanted to make the principal and interest portion of the payment, then that would also create a shortage because you didn't, those particular months that were deferred, or those particular months you only paid the principal and interest, there was no funds set aside for tax and insurance for those that should have been collected for those months. So that will create a shortage along with the changes, along with any potential shortages. It would make it even more shorter when we review it the following year. So that's just to give you a few examples. If you ever receive a deferral, whatever those additional escrow amounts are, you want to try to pay them, even if you can't pay them right there in that particular month. Again, let's say if your escrow analysis reviewed every March, then if you receive a deferral after that point in June or July, or let's say June or July, you ever only had to pay the principal and interest, then before the following March, when the new analysis is, if you do get some extra funds, just call in your servicer or whatever rep you speak with. Just have them tell you what's the monthly amount needed for your taxes and the insurance. So let's say if that's $300 a month for both taxes and the insurance on a monthly basis, then if you miss 4 months, then that 3 times 4 is $1,200. You want to just try to make an additional escrow payment towards your escrow for that $1,200. So at least it's not lacking for any months, again, you received a deferral, or any months you only paid the principal and interest. Because a lot of homeowners, again, they pay just the principal and interest portion of the payment, because just paying the principal and interest portion of the payment, that would move your account to the next month. Again, that's a gem. Just gave you a free gem that'll help you protect your credit. Even if you paid the principal and interest portion of the payment, right, and you didn't pay what would have been set aside for the tax and insurance, that'll still give you positive credit reporting. Even if you did that for the entire year, that's a fact. You can do that for every month of the year, you'll still get positive credit reporting. As long as you paid at least at minimum the principal and interest portion of the payment, at least in the month in which it's due. So if you owe for January, you at least want to pay that principal and interest portion of the payment in January. Don't pay the principal and interest portion of the payment for January's payment in February. That's asking for trouble, where you might get that potential negative impacts towards your credit for that month, right? Now, again, anytime you have to just pay the principal and interest portion of the payment, you want to just try to do so and make that additional escrow payment before the next yearly annual escrow analysis, so it doesn't create any additional shortages on top of any other changes that will occur on a yearly basis, okay? But again, man, it's a lot. Review the video more and more. If you need help with your loan documents and your escrow analysis, I'm available. There will be links, on the web where I'll be able to make it available to where you can reach out, to where, I can consult you and we can go over your loan documents. I don't need any of your personal information, but if you want me just to look at the escrow analysis, I can go over that with you. It's I've been doing this a lot, been talking a lot. It's about 34, 35 minutes, but that's how deep escrow goes. Escrow is very complex, and a lot of homeowners don't understand it. And then they call the servicer, why my payment increased? Well, you have to call the city or county in regards to any taxes. When it comes to the insurance, you have to call your insurance company that's insuring your property. They are responsible for the changes or the increases. The servicer would just make the necessary disbursements on your behalf to make sure your property is insured and to make sure that your taxes are paid. Okay? But peace, man. I hope this brought some light and some understanding to escrow analysis. This is how much detail this information is. Like, it's very complex. But again, as a homeowner, you can request an additional escrow analysis when you like. You can also schedule an additional funds on a monthly basis or a yearly basis towards your escrow. You can make an additional escrow payment. And if there are ever any additional funds in your escrow, like a surplus of funds needed, because you typically would have to have a required balance to make sure there's enough for your disbursements to be able to be made, any additional funds will typically be sent back to you as the homeowner. Again, if there's a surplus of funds in your escrow, that will be sent back to you as an escrow overage check, okay? Peace.